attending. So the
Yep,
webinar.
I can see that. Yep.
Cool.
And the red recording. They have spent a hell of a lot of money over the last 3 to 4 months around basically stimulating the economy and ensuring people are as best off as they practically can. You know, they've introduced JobKeeper, JobSeeker, cash flow boost for businesses, along with government grants like payroll tax reliefs, etc. So to the government's credit, they've done a hell of a lot there. The big question is, you know, what will happen when all these different stimulus packages finish? No, we don't have a crystal ball, so none of us have magical answers. And to be honest, every state will have different recovery timelines. So here I am in Victoria, and obviously you could argue in one way that we're the COVID capital of Australia at the moment, but ultimately I think our recovery is going to be a lot slower when you compare it to someone like Western Australia, who I noticed watching the AFL the other night had 30,000 people at the football, which is fantastic. So these are the different things that we just won't understand until as time goes on. Some of the facts around it all: credit card spending. So the CBA have actually provided data recently, though, that credit card spending is up 11.4% on this time last year. You know, and that's amazing from my perspective if a lot of people have lost jobs and are trying to be very, very careful. The gut feeling is that they're spending a lot of the government handouts at the moment rather than their hard-earned cash or savings. And that will probably cause more problems in the future and might provide opportunities down the track as well. The media, well, they've basically, about 30 minutes ago, our Prime Minister, Scott Morrison, came out and basically announced extensions to JobKeeper and the JobKeeper Seeker program. So basically they were due to finish late September, early October. Many of you that are possibly receiving those benefits or running small businesses, your accountants should obviously be proactive and start talking to you once it all goes through Treasury and we all have the proper updates. But ultimately, it's very important there that there is a possibility that if you tick the right boxes, that you'll be able to get JobKeeper and JobSeeker through to the end of March next year. So that will certainly provide some relief in the short term. Some of the things that I look at which will help determine where we're heading, you know, things like council permits or builders lodging plans, etc. Very, very big indicator, and is already proof that they are down. Now, that won't really have an effect right here and now, but certainly in 6 to 12 months down the track, when those permits would have started being worked on, it'll be interesting to see what effect that has on the property market. The confusing part, though, retail spending is actually up. Now, a lot of that is online, but you know, you go to these shopping centres and they're arguing many of their stores that there's actually an increase in retail spending, and that would go some way towards proving the CBA data as well around credit cards.
So hey, Peter, I'm back online now. Sorry about the beginning there, guys. My computer had a hissy fit. It was all working beautifully, and then Zoom decided to freeze. So my apologies for coming in late. But, Peter, you're doing a sterling job. I'll let you keep going right through. One thing I was just going to say about retail spending is what else can you do in a lockdown except for spend money, right?
Yeah, especially online as well. That's what's happening at the moment. So fantastic. Loss of jobs and income. A lot of people, as we've seen in the media, have lost jobs, or their hours have been cut quite dramatically. How long is that going to last? And the classic example is the airline industry, where they've sacked tens of thousands of people. A lot of this will have a big effect on the economy, not right now, but certainly once the stimulus packages do slow down and cease. So that'll be very interesting. And the big one, which I think we haven't even seen the start of yet, is debt. You know, and we'll speak about LVRs in a moment, but can people, we know the banks have come out and given debt relief to a lot of people that are finding it tough to pay their current mortgage repayments. That's due to be in line for 6 months. Now that the government have announced extensions to their stimulus side, I'm not sure if the banks will follow suit, but ultimately those mortgages will still need to be paid and people will need to catch up. So how long is that going to last for? And more importantly, will we see a recession come into play where people will walk into the bank and hand over their keys simply because they cannot make the mortgage repayments anymore? And that's exactly what happened through the GFC time. So ultimately, that's going to cause some people in the future to basically cause further problems.
Just a quick question there on that. Sure. My thoughts are the difference between 2020 COVID crisis and GFC. Interest rates back in 2008, 2009 were a lot higher.
Yes.
Interest rates now are much lower. So I think one thing obviously that's positive is that we have lower mortgage rates. So it means that generally people can refinance and sustain their payments. During the GFC, it was a bit tougher, I think, for some people. So perhaps that's one sort of softener, if you like, because people are saying, oh, there's going to be blood on the street, but I haven't seen any widespread evidence of that at this stage.
Yeah, no, I'm not sure if blood on the street is going to be the right word. I think it'll ultimately come down to each household or each business out there and what their borrowings were before this and how they were actually doing it. The bigger effect, I think, if both income earners have lost a job, how are they going to make a mortgage repayment, or how are they going to pay the rent, if you like? But you're spot on when you say, let's see what happens down the track. I think, you know, my recommendation down the bottom, and yes, in the middle of this COVID mess, it's certainly true, cash is king. Ultimately, that has always been the case. And the reason why people struggle cash flow wise, or why they get themselves into financial trouble, is if they're borrowing too much. Now, that could be for a house, that could be motor vehicles, that could be for your famous European vacation that we'd all love to be doing right now. But ultimately, cash is king. It always has been, and it always will be. So whatever you can do to make that basically your number one goal, I would be doing right here and now, because then it will help in the future, whatever that crystal ball looks like. Let's have a look at the, let's have a look at the next bit. So LVRs, loan to value ratio. So this is a very important thing. I will presume that most of you know out there, keen property investors, what an LVR is, but it's quite simply the loan amount divided by your property value will give you an LVR, or a percentage that you've ultimately borrowed. What is the correct amount here? And I always argue that less is always better, okay? And for the simple reason is that the less borrowings that you have, the more that you can concentrate on knocking down the principal quicker. And that will help you build equity, and will certainly go a long way towards allowing you to possibly buy your next investment property, or whatever that may be. You know, so less is always better from my perspective. What are the considerations that you look at? You know, how much are your salary and wages? And is there a, job security, especially in these times? You need to consider those factors. Is there other income coming in, for example, from other investments like another rental property, etc.? Your expenses and liabilities. So can you actually afford to go and buy a $500,000 house and borrow 450, considering your existing debt that you may have to repay? Interest rates is a very, very, very big part of this. And as Rich just alluded to earlier, are you on fixed rates? Are you on variable rates? Have you got the potential to adjust it? The one thing I would suggest is the banks are very hungry right at the moment for the right clients and new clients. And we've now got clients, so we do have an internal loan brokerage division, and a lot of the loans that we're negotiating are starting with twos. So ultimately, if you are in a position where you're still paying 4 or 5%, even high threes, it's probably way too much. You know, I had a client I spoke to this morning and they're paying above 4% on a home loan still. So we're going to look at that and renegotiate it down. But you need to be basically keeping the banks on account or keeping them accountable to give you the best possible deal. And that's very, very important. Fixed versus variable interest rates, like Rich alluded to, I'm not sure how much lower they can actually go before the banks will start paying us money, which I don't think that'll ever happen. But ultimately, it's very important to consider that. And I've basically put a link here in place back to our website, and we have a brochure there that talks about the benefits and what you need to look at when you're looking at your interest rate around fixed and variable. But the key here with your LVRs, the less, the better. For the simple reason, it'll give you comfort, and I call it the sleep test, which will allow you to sleep at night. But more importantly, it'll allow you to fast track your next investment or your next property purchase. And that's the key there. Okay. Next one, depreciation on older properties. So a lot of clients come to us, and especially new clients that come across Chan and Naylor. And the one thing that we do notice is that a lot of them have never been advised or don't know that they can actually claim depreciation. And what is depreciation? There's basically two types. So the first thing is on a rental property. Let's just refer to it as normal on your plant and equipment. An example of that would be the curtains or the split system air conditioner on the wall, or dishwashers and ovens. These items are things that need to be replaced from time to time, and generally the ATO legislation allows us to claim depreciation on those things. The other big one, which a lot of clients or a lot of prospects that come to Chan and Naylor, and I'm sure Rich sees this out there as well, people are unaware that you can actually claim depreciation via the structural or the building that in fact is there. And simply put, any residential property built after the 15th of September 1987, there is the chance to claim depreciation on the construction costs. And you can see the date there for commercial properties as well. Now that is only 2.5%. Yes, granted, but imagine if a building costs $200,000 to build at 2.5%. That's a $5,000 per year tax deduction that's not coming out of your pocket. So that's what I refer to there below being non-cash, and you're getting the benefit from. So I'm not sure why people are not aware of this, or why they say, nah, it's not worth doing it, because the cost of these are around $500 to $600, which is also tax deductible.
Peter,
Sorry, Rich.
Quickly just say that some of the companies that provide these reports basically guarantee that they'll be able to save you a lot more than the cost of the report.
100% they do.
I just basically, to summarise, because we're just running a bit short of time, Peter, summarise to say definitely get a depreciation expert to do this for you, and it makes your job as an accountant a lot easier too as well, Peter.
It does, certainly. So that's very important from people's perspective. Negative gearing, is it dead? It's a funny thing, negative gearing. Quite simply, it's where the expenses to do with the property are greater than the income, okay? But most importantly, it's a tax strategy only. Just remember one thing, if your expenses are greater than the income, you're still losing money. Yes, you will get a tax benefit for it, but the whole idea here is, are you in the subject of building wealth, not debt? So again, as an accountant and as someone instructing you to build your wealth, get rid of the debt. Decrease your LVR. It'll help you making more investments, where some people say, no, I just want a tax deduction. So I'm not sure why people would just want to make a loss to get a tax deduction, but ultimately, and be very, very careful. We went to the last election and the Labor Party quite clearly said the possibility of changing negative gearing laws. So when you're making an investment, make that investment to make money, to get positive cash flow. Because ultimately, whenever you get to your magical age, whatever that is, the more cash you have and the more passive income that's coming in, most importantly, the more choices you will have later on. And that's the key. Ongoing tax benefits, just being wary of the time side of things, but generally speaking, same tax deductions apply generally for all ownership questions. So depreciation we spoke about, yes, interest that you pay to the bank. Be very, very careful about repairs versus capital improvements. It's a very topical thing out there with the ATO right here and now. So we need to be very careful in that regard of what is a repair versus a capital upgrade. Again, refer to our website and there's brochures on that. Get educated is the key rule here on what you can claim and what you cannot claim. Because again, what we see is people are just not claiming the things that they should be claiming. And this is money that you're missing out on, which you could be putting against the principal debt. So most importantly, get educated on what you can and cannot do. Structuring. One of the most important things when you buy a property is whose name do I put it in? Or what structure do I buy it in? A lot of people think this is just not important, which is, I'll abolish that theory right here and now. You need to speak to an expert, being an accountant, being a property advocate, whoever that is, not your brother-in-law who's a plumber. And just because he did it this way, that's why I did it. Speak to the experts. If you're going to be spending $500,000 plus on an investment property and a consultation costs you $500 or $1,000, surely in the bigger scheme of things, that's not applicable to the mistakes that you could possibly make. When should you set up a structure or at least have the discussions? Ideally before you sign the contract. A lot of the states have different laws, but you could get hit with possible stamp duty if you try to change things down the track. What are the 4 major things when you're looking at structuring? Asset protection is big. So how do we transfer risk? Tax strategy, obviously minimizing taxes where legally possible. Estate planning. Can we pass things from generation to generation without capital gains tax kicking in, without stamp duty problems? And you should always control an asset rather than have full ownership. That's the key. And that's the same with those of you in business as well. What are the types of structures out there? Obviously individually, companies, trusts, and there are a number of trusts as you can see. And SMSFs is a big one over the last decade or so once the government changed the borrowing rules in that regard. I will mention quickly here at Chan and Naylor, we do have what's called a property investor trust, which many, many of our clients benefit from, or what we refer to as a PIT. We have a separate tax ruling on that. Some of the major differences is it doesn't have a vesting date, whereas most trusts only last 80 years. Lineage clauses, which means it can pass to generations quite easily, but the big one being the ability to pass negative gearing on to an individual through a trust rather than having it in an individual name. And generally speaking, I'm wary of time, but that's how a PIT does work. I believe we're going to be forwarding all the slides after this presentation. So by all means, if anyone has any further problems or questions around a PIT, and I've also enclosed here a link to our website, which has case studies and examples of how to do it. But the one thing I would recommend when you're buying a property, which structure? You must be undertaking a cost versus benefit analysis. So what is the cost of setting up and running a structure? What are the benefits we are going to receive? And then you'll know which way to go. Very, very important. And it's, remember one thing, you don't own a property just for 1 year, or very rarely do we do that. So when you do your cost versus benefit analysis, you don't just look at next year's tax refund and say, great, I'll do it this way because I'm going to get a negative gearing amount back. How about when you sell it and the property's doubled in value? Then you'll probably be screaming because you'll have to write the ATO a check for 100,000 possibly. So very, very important to look at the whole picture. Very important. Prepaying interest, is it really worth it still out there? The short answer is you have the ability to prepay interest on any investment for a 12-month period. What do you need to consider? Well, what will the interest rates do in the next 12 months? Most importantly, here we are, we've just rolled into a new financial year, and let's say in June you prepaid the interest for the coming 12 months. Fantastic, you'll get a tax deduction for that. But then what happens in 12 months later? Are you going to do the same thing? So this is where it needs to be regularly reviewed and analysed, and your personal tax rates need to be taken into account, not just this year, but also next year. But if you've got some cash flow, it's certainly a great strategy to consider. In summing up, so I think that's sort of the 30-minute timeline. Some take homes, or what should you be looking at? Investment structuring. Look at it before you sign a contract. If there's one thing you get out of all this, that's the most important. Make sure all your compliance is up to date with the ATO. And that's obviously our tax returns. If you're in business, it's BASs and supers, etc. The ATO, or as I alluded to earlier, the government has spent a lot of money recently for obvious reasons. The ATO will eventually, from the government, start chasing people that maybe their tax returns are behind, that owe money to the ATO. Banks will not deal with you if you have ATO debt or if your lodgements are 3 years behind. So if you want the power to grow your wealth, you should ensure that your compliance is always up to date. Talk to your trusted advisor. Like I said, build a network around you and talk to your trusted advisor. If you haven't got one, find one or give us a call. I'm sure Rich will be happy to help. But ultimately, you need to have an accountant or a property advocate around you that's going to help you achieve your goals and objectives. Review and speak to your bank regularly. So like I said, here at Chan and Naylor, we have a loan broker, Lucy, that works inside our business. And ultimately, she's forever reviewing clients' affairs to see if we can get the banks to sharpen their pencil. The banks are very hungry for the right client here and now. And if you're paying anything more than a 2 in front of your interest rate, you're probably paying too much. Speak to the banks, keep them honest, because they're not going to ring you and say, congratulations, we're going to decrease your interest rate. Guys, it's totally, you have to be proactive. An analysis. So what we do with a lot of our clients, and those of you that are interested can certainly contact us, and I've got contact details listed here. Strategic financial consultation for property investors. So like I said, what do we get a lot of the time? We have clients that come to us and say, I'm not sure if my accountant's doing the right thing. Can you please review things? This is all about it on our website. By all means, jump on there and have a read of it. But ultimately, we have to make sure the wealth is staying in your pocket. You're not giving it to the banks unnecessarily, and you're not giving it to the ATO unnecessarily. Very, very important. Investing in business. Picture a bridge. You need to build that bridge and get to the other side. Whatever your goals and objectives are, work out a way to achieve them. Surround yourself with the right people to help you achieve all that type of stuff. Very, very important. And I call it the bridge analogy, guys. But apart from that, I would like to take this opportunity. Rich, thank you very much for inviting me to come along, even with our COVID problem here in Melbourne. I appreciate that. But ultimately, if anyone needs help, there's our contact details by all means. Rich and his team will be forwarding PDFs of the slides that I've gone through. Visit the website. Whatever we can do to help, we're certainly here to help. I know there's been a few questions come through, but I'll let Rich fire those at me.
So what we might do, Peter, what we might do is just, I thank the people that have filled in the questions. I'm just going to do my short 20-minute presentation about where the market's up to. And then I'm going to leave 10 minutes at the end of the presentation to answer all those tax questions that have come up, as well as the questions from my presentation. So Peter, can I ask you to stop sharing your screen?
No problem. I'll do
share
that
my screen
right now. Yep.
Thanks for that. Sorry about the technical difficulties at the beginning of the program, but my laptop decided to chuck a hissy fit, and we had a major issue. So again,
no problem.
Here we go. So look, thanks again for joining us, everybody. I'm Rich Harvey, the CEO of Propertybuyer, an independent buyers advocate. So I'll just put that on presentation mode, slideshow, and oh, hang on, that's going to go the wrong one. Which one have you got, Peter? Is that my presentation screen or the full screen?
That's got 2 slides on it,
Yeah,
Rich.
sorry, I'll just take it off because I'll get the right view so it's not on presentation mode. Slideshow. Sorry, what's the button? I always forget which button it is.
Good
hang
question.
on. What I'll do is I'll just do that, and then I'll do that, and then I'll go back to, just give me 1 second.
Technology, eh?
Oh, it's great, isn't it? Yeah. Oh, I can't find it. Hang on. I've just got to go back to there. Sorry. It's on. Oh, someone's going to put up their hand and say, Rich, press this button.
There's a bottom right-hand side, Rich.
Bottom right-hand side. Is it reading pane slideshow?
Thanks, Matt.
Normal. No, that's not it. It's not that one. There's a button called presenter mode, and I don't want to be in presenter mode. So anyway, look, you can probably just watch it from this one here. So here we go. Sorry, guys. Press F5. Someone's telling me to press F5. Is that the one? No, that gives me presenter mode still. Sorry, I'll just go back to share screen. There we go. Anyway, well, let's get stuck into it. So with my credentials, just as a background, been running Propertybuyer for 20 years and over 34 awards for excellence. We've purchased over 3,000 properties. So we know a thing or two about properties and been in the property game a long time. I've also served as the president of the Buyers Agent Association of Australia and also the chairman of the Buyers Agent Chapter of the Real Estate Institute for a number of years, and also a fully qualified property investment advisor. Quick overview. What I want to present today is just a quick overview of where the property market's heading the next 6 to 12 months with COVID. Then we're going to talk about this September cliff theory, talk about corona impacts and buyer behaviour, and also just how to take advantage of the current conditions in the market. Because a lot of people are thinking, I should sit on my hands. Well, there's also an alternate theory that you can take advantage of the current market. So what's been happening with auctions? Well, unfortunately in Melbourne, because of COVID, it certainly took a dive last week, and clearance rates were only 42%. In Sydney, they were pretty healthy, 68%. Brisbane, 53%, Adelaide, 61%, and Canberra, 86%. Obviously, Sydney and Melbourne are the 2 auction capitals of Australia. But what is interesting is that you can't judge the market on one particular weekend or one overall statistic. Auction clearance rates are just one leading indicator, and they don't always identify exactly what's happening in the market. But they are a good sort of litmus test as to what's actually happening. In terms of prices, over the last quarter, we've seen property prices retract 2.3% in Melbourne for the quarter and 0.8% in Sydney. Now, there's always a bit of a lag effect in terms of COVID on the market, but I suspect that the prices will have dropped much further in July, in the next quarter as well. But if you look at it on a yearly basis, the prices have actually been remarkably resilient. Over year to date change, Melbourne has actually increased 10% and Sydney's up 13% on this time last year. So when we had the election last year, we had 2 months of kind of coming out of realising that we had a stable government, and then we had the market really pick up pace for about 5 months until December, and then February and March was pretty strong, and then COVID hit and everything went into lockdown. We've seen quite a dramatic reduction in transactions and turnover and pricing. As we said, Sydney prices are down for the quarter, but up. So we're actually, Sydney's down 3.5% from its peak in July 2017. And that's an interesting stat. So you can see the curve there starting to come down. For Melbourne, a similar kind of number. Melbourne's down 2.3% from its record high, which was actually in March this year. So we're not, we haven't had the 10 to 30% drops that a lot of the media has been talking about. So by the way, if anyone does want a copy of all of the slides, both mine and Peter's, just send an email to us. We'll send out a link, so don't stress, but we'll send out a link with an attachment. But please just shoot us an email in case you don't receive it or it goes to your spam. I want to talk now briefly about listing volumes. So listing volumes have really taken a hit, and this is reflective of confidence. We saw that the market started to recover quite strongly in February and early March. And you typically then get two kind of peaks of listings. You get one in early March, and then you typically get a peak in sort of late October, in that late spring season. But look at this orange line here. This shows the total volume of new listings, and it's significantly down, almost 50% compared to a 2016-2017 year. So that's why, if you're struggling to buy a property or find one, that's the reason why, is that vendors are nervous. They don't want to list their properties because they fear of the unknown at the moment. That's what we're seeing out there. Now, I want to address this kind of major question on everybody's lips, is that has coronavirus fundamentally changed the property market? Well, we started 2020 with quite optimistic hopes, obviously, and we had a robust growing economy, but we've had a major health crisis that's caused an economic impact, but it hasn't fundamentally changed the market. There are certain things that are going to change, but the main drivers of the property market haven't changed over time. Confidence is very tightly and very, very closely tied to the performance of the property market. So let's have a quick look at the key drivers of the property market and what's happening to each of these at the moment. Population growth, well, people are still having babies, but migration is obviously, the borders are closed, so migration is significantly affected, and that will have a dramatic short-term impact on the property market. We were having migration numbers between 160 to 190,000, but I think the number for this current financial year is going to be about 90,000, so significantly down. Employment, obviously unemployment has risen, and that's having a dramatic impact, but it's certainly confined to some major impacts confined to hospitality, travel, and certain other sectors. And so the government's providing specific support and JobKeeper for those sectors. So that's something that will recover, but it will take time. And the overall economy, obviously, is being dramatically impacted. Interest rates are at their lowest level ever, to try to stimulate investment, and building approvals are taking a bit of a hit. So there's certainly, those are the key factors that will drive the market. But again, I've got to emphasize, it's going to be a temporary impact. Once the vaccine is eventually developed and once we see confidence restored, it's amazing how fast the property market turned the tap off. But watch if migration picks up, if employment picks up, watch again how quickly it might pick up on the other side of that. I mentioned consumer confidence. It has a dramatic impact, and you can see here in April and May, it dramatically dropped down. Then it recovered, and then it's dropping down again. So as we get these second waves coming through, it has an immediate impact on people's bottom lines and people's propensity to spend money. So what are the buyers sort of doing at the moment? I tried to think of an analogy, and I came up with this one, is that they're circling like hawks. What's interesting is that we had a record number of visitors to our website in the last 3 months. People want information. Even looking at the number of people, obviously, on this webinar and other webinars I've done, I think I did one earlier in the year, Peter, and we had over 750 people register, just wanting information, which is great. Everybody needs information. But I think a lot of buyers are just holding off pulling the trigger on the purchase because they're just not sure what's going to happen. They're worried about buying a property that might fall in value versus sort of picking the bottom of the market, which is a difficult thing to do. So what are the things that are holding buyers back at the moment? Well, I've basically come up with these two little acronyms, FUDs and CABs. So by FUDs, I mean fear, uncertainty, and doubt. They're the three things in a lot of buyers' minds at the moment. You know, worried about the economy, worried about property prices, worried about their jobs, and all legitimate concerns. And if you can flip that around, you know, you want to have cabs. You want to get into a cab. You want confidence, you want assurance, and you've got to have belief. And if you're an active investor, you've got to work out the best way to spend your money to get the best return. So these are the kind of emotions that people go through. I've come up with this idea of a cycle of property emotions, if you like. You know, we often start this idea of thinking about buying a property full of joy and confidence and enthusiasm. And then we actually buy and we become jubilant. But then we start to worry, gosh, have we made the right decision? Do we get buyer's remorse? And we end up sort of almost getting down to this point of depression and gloom. And then we start to see property prices recover and we have reassurance, relief, and confidence again. So it's important if you're a home buyer or an investor to be aware of how emotions can impact your decision making and learn how to take steps to educate yourself, as Peter's talked about, to get through and make the right decisions. I thought I'd put this slide up about house prices and taking the long-term view. And it's important when you are doing a property investment that you're not just a short-term trader, unless you're very skilled or you're a builder or a developer. But if you look at all of the sort of crises we've had, you know, right back into the 70s with oil shocks and, you know, negative gearing was removed for a period of time, and we've had first home buyer grants, the GFC. You know, we've had a lot of times where the market's been negative. There's probably 6 to 7 times there below the line. But look at also the times above the line that property prices have skyrocketed or jumped dramatically over a period of time. So I think any investor that's in the market has got to take a long-term perspective and not try to pick the exact bottom of the market, or again, watch out for the top of the market. So you've got to, you know, have a very, very judicious approach to doing property investment well. So where are property prices heading? That's the $1 million question that you all want to know. So here's my little crystal ball. Let's just rub it and see what happens. But market sentiment, as I said, is a key indicator of where we think prices are going. We're starting to see auction clearance rates are actually relatively stable once we get through these second waves of COVID, you know, above 60%. But I think everybody should be aware of how much the media will impact your decision making. And it's important to not let that drive your decision making. You've got to identify local factors and local information and not understand the property market as one market, but it's made up of individual suburbs. And you've got to do hyper research based on a locality to identify the best areas. So key things to be looking for are the volume of sales and the volume of listings. So at the moment, we've had, as I said, a real shortage of listings, and that's holding prices up. But what we're seeing is the rate of absorption, or that is the number of properties coming on the market, are being absorbed faster than they're being sold. Sorry, properties are being sold faster than they're being listed. So we've actually got a ratio of list to sell of about 1.3. So again, we're not satisfying, even in this market, enough demand in the prime areas. So what should you do, or how should you approach the market, particularly during COVID and during this time? Well, I'm always one for being a contrarian investor. During the GFC, I bought 3 properties that year myself because I saw it was a wonderful opportunity to get cashed up and to buy well at lower prices. So you don't tend to get these kind of dramatic pauses all that often in the property cycle. And I think the next 6 months is going to be very much one of those pause periods. So, you know, we've heard about the JobKeeper finishing in September. Well, that's now being extended at a lower rate. So I don't think you're going to get the fiscal cliff that everybody's been talking about. We're pretty fortunate in our ability to provide a welfare net for most people. But I'd approach the market with cautious optimism. I'm not saying you should buy any property, but as Peter talked about, get the right team around you, get the right information. And my other thing is, this saying is, always buy your straw hats in winter. In other words, buy when people are running the other way. A lot of people are saying, Rich, I'm going to wait till September, October to buy. But what you will find is that actually there'll be a lot of other buyers in the market at the same time. So there will be increased competition from other bargain hunters all at the same time. So my view is when you find the right property, go for it. You know, do your research and buy it if it's the right one. If the market were to drop a couple more percent, it doesn't matter because you're going to make it up on the other side. But you've got ahead of the competition and ahead of the curve. So if you are thinking of buying, just got a couple more slides to go through, and these are about the 7 steps that I take myself and that I work as a buyer's agent in helping people to undertake these steps. First step is understand your strategy. If you're a home buyer, you're picking the right area for your lifestyle. If you're an investor, it's about maximising both the capital growth and the yield. So you've got to create a property brief, and then from there, pick the right areas and the right suburbs that will deliver the capital growth and the yield that you're looking for. So we give our clients a very detailed report, a prelim research profile on the suburbs that we're looking for, and then we start the search process. Most people go straight to step 3. They jump online, have a look at what's available on realestate.com, and then get a bit frustrated. Well, that's our 3rd step. As part of our 3rd step, we also identify a huge number of off-market properties. Because we've been in business over 20 years, we've got over thousands and thousands of agents on our database that we can send emails to find off-market opportunities. Next step is you've got to evaluate it. You've got to do your due diligence, get your pest and building done, work out what the value of the property is based on comparable sales. We spend about 2.5 hours on a specific property to identify what the value is. Most people will just look at a couple of sales, but you've got to look at sales not just 3 months ago, but up to 6 months ago to get a real sense of where the market's at. Then you've got to negotiate well, organise your contract review, get the property secured, pay your deposit, and then find a property manager. So they're the basic steps that we go through to help our clients to buy well. And just as an example, I've got just 3 examples to finish up on of what we've been able to achieve for our clients recently. We got a couple of what we call property COVID discounts for our client. So I bought this property earlier in the year. I had a client with a budget up to 1.2. I found an off-market property, 400 metres to the Manly Ferry Wharf. It's a lovely 2-bed, 1-bath, 1 car, and we got that property for 1.19. And the property directly above it, it recently sold for 1.3, or had recently sold for 1.3. So huge saving for our client, and that rents at around $800 a week. So it's a, you know, with the right deposit, it's going to be cash flow neutral. Another one we bought in Western Sydney, where we've done a lot of work there. This had the ability to add a granny flat. The owner on this one wanted $735, but we managed to negotiate a significant discount, saved our client around 65 grand. But that will rent, once you add the granny flat, we'll probably end up getting about a 6% gross yield on that property in Sydney, which is quite remarkable in the current market. And our 3rd one I've got here is a home buyer I helped earlier in the year. Found a property up near Pennant Hills. It's a lovely family home. Needed a reno, but I was able to get through the first day it was on the market. And the agent said to me, Rich, I don't know why I'm letting you through. You know, I said, I've got 5 other buyers that want to have a look on Saturday. I said, oh, please, could you just let me through? My clients have got 2 little ones and we can't get there on Saturday. She said, oh, okay. So we looked at it on the Wednesday, made an offer on the Thursday. Pest and building was done on Friday and exchanged it that day. So within 2 days of coming on the market, we had it wrapped up and we saved our client over $150,000 based on comparable sales. So if you can move quickly and have the right information, you can save yourself quite a bit of money, particularly in this market, if you can find the right kind of motivated vendors to move forward. So that's all. I've got more I'd love to talk about. If you'd like to get in touch with myself and my team, we'd love to help you find your next property, your home or investment property. Just shoot me an email to rich@propertybuyer.com.au. And as I've said before, Peter, you might just want to unmute yourself so you can do the Q&A. We might just do the Q&A session now. And there's a couple of questions that have come up on the chat. I'll just pull them up and quite a few tax ones. So let me just hit off with these ones. I have an investment loan. This is over 4%. Can this be negotiated lower? The answer is absolutely yes. We'll send out the presentations. Number 2. Here's one for you, Peter. Since I lived overseas in the past 7 years, the tax credits due to negative gearing have not been used. Will I be able to claim this when I come back to Australia next year?
Yeah, there's quite a bit in that question right then and there, Rich. I'd need to understand a lot more facts around it, to be honest, rather than say yes or no. Happy for that person to reach out and get in contact and see if we can help at all. But it's not a black and white answer, which a lot of the tax legislation's not.
Sure. All right. Yep. Another one for you. We're considering renting out our primary residence and renting a place for a sea change. What is the tax implication of this?
Yeah, again, that's a massive one. There are some tax implications because there's the possibility, and depending upon how long you're going to be doing that for, that your principal residence could transform to an investment property. There are rules around that, which means we can get around it as much as practically possible. But again, that'd be probably something I'd need to talk to that individual about to advise further of all the steps required. But it's a common thing out there that does happen, yes.
Oh, okay. Another question. We have some investment properties bought in our names rather than via a structure. Can we adopt the trust structure to avail the benefits?
Yeah, sure. So there's probably yes and no to that question. Like I said earlier, before you're purchasing a property, the correct name should be on a contract. If you try and transfer properties afterwards, we need to look at two major considerations. One is capital gains tax, and the second one is stamp duty laws, depending upon the appropriate state and their respective state revenue office. So again, it might be very difficult with existing properties, but certainly something for future. But again, happy to have a chat to see if we can assist there.
There's another one about structure, but I think again, that's about starting a business name. I'd just recommend that person see you directly.
Yeah.
Oh, wow, it's a really long question. The risk of knock-on effects of COVID is underreported. As accountants, what are you seeing, Peter? Will the world ever be the same? Are many businesses going to go under? Will builders face solvency? What do you think?
Yeah, great question. I mean, it's the crystal ball factor again. The only thing I would say is we will recover. We just don't know how and when. You know, we went through a pretty big thing a few years back, which was called a GFC, and it was like the world was going to end. But within a couple of years, we got through it. The one thing I would say about Australia compared to the rest of the world, we really are a lucky country, and we really have our finances and our wealth and all that in with our ducks lined up, and I think we'll get through it. Even as a business owner, I've learnt a lot of things, and I'm sure we all will. So there'll be different things that we do from here on in. However, we will get through it in some shape or a matter. It just depends what it looks like out the other end is the key.
Just to answer that question myself, I think, again, I'm learning a lot of things as a business owner about being adaptable. And I think, you know, just like in Darwinian theory, those that adapt survive. You have to be resourceful, you have to be thrifty. And if you just sit on your hands and do nothing, then everything will run past you. But I do think Australia is very much still a lucky country in that we are nimble. You know, we have a small population, we have an intelligent population. We also have a very attractive environment. And if you look at both our political system, our natural environment, our natural resources, our education system, we are just incredibly blessed as a nation. And a lot of people want to come and live here. So I think migration will rebound quite strongly, and it'll be hard for the government to stop the volume of people that want to come. And I think we're a very resilient nation. Look at our wartime years, you know, we've come through. But it's not going to happen overnight. It's not going to happen very quickly. I think we're going to have more a bumpy sort of recovery, but I do think we're going to get back over there in time.
Yeah.
Question, through our self-managed super fund, can we purchase one of the properties we develop through our development company?
Yeah, there are numerous legislation issues in super funds compared to you and I personally, or through trusts, etc. Generally speaking, a super fund cannot buy residential property from a member. However, if it is a commercial development, there might be that opportunity. So again, I'd need to understand the facts a bit more before I could, guide in that regard. Happy to have a chat.
Okay, great. There's a couple of structuring questions. Just a question about depreciation. Am I able to claim depreciation on properties bought after 2017 with no subsequent improvements?
Yes, well, again, it depends on when the property was built and when you purchased, but again, that'd be understanding a little bit more, and certainly the right quantity surveyor would give you that answer 100%. So there's many companies out there that do it, and we could certainly guide in that regard.
Yeah. Okay. There's quite a few questions about depreciation. Can you claim property mentor membership fees if you're a property investor? Well, I'll answer that one. I mean, I'm not an accountant, Peter. As long as it's connected with the activity that's generating the income you're earning. So there's got to be a direct connection with your membership fees to your property investment activity, right? You agree with that one?
Yep.
Can you claim travel for your self-managed, SMF residential property?
So through a self-managed super fund?
Yeah, can you claim travel?
The short answer is no. A trustee cannot be paid for services rendered, so no.
And generally travel to your property has been now, that's been reversed, hasn't it? That's been taken.
It has, yeah. A couple of years ago, that was sort of tipped on its head. Yep.
Another question, self-managed super fund mortgages, they're higher. Why are the interest rates higher on those?
Yeah, sure. So the interest rates in a self-managed super fund are higher because there's more risk to the banks. It's what's called limited recourse borrowing. And basically, because of those laws, John Howard back in 2007, when he created the laws, didn't want the banks to get their hands on our superannuation funds. So it's not as simple as the law that's set up for you or me personally. And because of the more risk associated with a bank, they of course don't want to be out of pocket, so they charge a higher interest rate accordingly. The big four banks have also walked away from lending to super funds. There is second and third tier banks that now do it. So the rates are a little bit better than what they were a couple of years ago, but there's just so many more ticks and balances with borrowing through a super fund compared to you or I borrowing or through a trust structure, for argument's sake.
And just generally, your advice on buying property through a self-managed super fund, is it a strategy you still recommend to invest in?
Yeah, I always say if it's the right property, the one thing with superannuation which you need to ask yourself, and I think for good reason the law has changed where we need to get a financial planner involved now to make sure that it's in your best interests. The key there is superannuation is all about your retirement, and it's a nest egg for later on in life. So if you are more than happy to purchase something, hold on to it for a long time, and then that will help you down the track you believe, it's certainly a fantastic strategy. The other thing that a lot of our clients do is they actually buy the property that maybe their business is operating in, and it's a way of renting it and funding commercial premises, for argument's sake, or that factory. And if it's all done correctly, that is a fantastic strategy as well. Right. It depends on the type of the property, and the one rule, is it in your best interest to do so?
Yep, great, perfect.
Yep.
Another question, what is the value of assets you need to have before it is worthwhile paying for a trust to be set up?
It's the $1 million question, to be honest. It's a bit like how long is a piece of string. I don't think there is a value of the asset. I think it just determines on so many factors like tax savings, like asset protection, like just so many other factors. You can't put a value of a property to say X amount of dollars, so you must put it in a trust. I don't think that's the answer, to be honest.
I'd probably say it's to do with risk, Peter. I mean, for myself, I've set up my structures with multiple trust structures, and I think it's about risk and minimizing the risk and also maximizing your tax effectiveness. That's how I look at it. Whether you've got
Yeah, you're right.
$100,000 property or $1 million property, it's all about
100%.
asset protection. Yeah.
And the one thing I probably would add to that, you're right. It is a way of transferring risk. And here we all are. We own a motor vehicle. It might be worth $30,000, $40,000. You know, that vehicle, and we pay $1,000 a year to insure the thing. But ultimately, people won't spend $500 to have a consultation when they're going to spend $1 million on a property, which just confuses me sometimes, because you think the risk would be a lot further or a lot higher. But it all comes down to yeah, right, your protection and risk transfer.
A great question. Often this one's misunderstood. Do you pay back depreciation when you sell?
Yeah, great question. So again, the laws changed a few years ago. So generally speaking, yes, is the general. So it gets basically, it increases the capital gain. Yes.
Yep. Okay. I'm just going to skip this. I'm just in the chat now, just going through what I've missed out. Rich, what's your view of bulk buying discounts? Is this genuine? Yes, I actually just got today a block of apartments, brand new, that I can buy the entire group of 32 apartments at about a 20% discount, but they have to, the catch is you've got to buy all of them. So buying individually, you won't get a discount. You may get a small discount, but you need to be able to, like an investment fund or a sovereign wealth fund that we represent occasionally, you need to be a bigger fund to get those kind of discounts. What's another one? Will high-rise towers prices crash due to people having bad experiences being locked down in a terrible environment? Look, apartment prices, I don't think will crash. I mean, in Sydney, you've had Mascot Towers and Opal Towers and a debacle with the a structural fault. And certainly those towers have got a huge stigma to them. So those properties will always trade at a discount to market value. But I don't think the overall prices of apartments will crash due to Corona. But I do think that people will be very picky about the type of property that they buy in the future, particularly the working from home phenomenon. I think people will want a little study nook, or if they're buying a house, will want a separate room for a working environment, or even a separate space outside or a flat to work in. So I think there'll be different changes going forward as to what people want in their homes. What's another question here? Just scrolling through. My wife has permanent residence. Can she buy a property with everything as the same as a citizen? Well, yes, correct. If they've got permanent residence, they can. There's no restriction there on what they buy. What is the strategy with investment property and restricted stock units? Is that one for you, Peter?
I'm not sure what they mean by restricted stock units, to be honest.
I'm not sure.
Maybe it's a property trust of some type, possibly. Yeah. I'm not sure, to be honest.
Okay.
Yeah.
Another question, for how long do you need to move back into your principal place of residence to restart the 6-year capital gain tax exemption rule?
Yeah, there's no black or white, 2 months or 6 months or anything like that. There's so many factors that need to be considered. Like I said, the ATO legislation is not black or white to say 186 days. So the short answer is I'd need to go through that and explain all the other factors that would be considered. The whole idea is if the ATO was to audit or to review, that you've got the appropriate facts lined up to ensure that you'd be okay.
Perfect.
Yep.
There are quite a few more questions, and I'm very sorry we have run out of time, but I just want to say thank you so much, everyone, for coming today and participating for our webinar. I know time is short, and we will be providing both a copy of the slides and a copy of the recording. The first couple of slides, I'm sorry, Peter, we missed out because my Zoom decided to crash at the very beginning of this webinar, so not sure why. It was all working beautifully 10 minutes before, but just want to say thank you, Peter, for your kind words and giving up your time today. And really appreciate it.
Great to be part of it. Happy to help where we can.
And just like for ourselves at Property Buyer and Shannon Naylor, we just want to say thank you for coming. And if you have further questions, please make contact. And we look forward to connecting with you again in the future. So thanks again. Thanks, Peter. Thanks.
Fantastic. Thanks, guys. Take care. Bye-bye.
Bye.